Hi, I'm Lavigne with Utah Working Capital. Now I'd like to talk about how a small convenience store would create a balance sheet. The first thing that a convenience store needs to do is understand all of the assets that the business owns. This includes all of the cash accounts on hand, and specifically it's going to include all of the inventory that the convenience store might have. This might require taking stock of inventory on a regular basis and understanding exactly all of the goods and merchandise which is within the convenience store that is readily available to sell. After calculating all of the cash and inventory, a convenience store would then add up all of its fixed assets, so the building or the land that it might be sitting on, as well as any equipment that's used to run the business, like a cash register or computer equipment or other machinery that might be needed. Third, the company is then going to go through and look at any other assets that it might have and include this in the total of its assets as well, so that it understands exactly what it owns going forward. The second part of building the balance sheet would be for the convenience store to go through and understand all of its liabilities. First, calculate everything that it owns, from debt or small business loans to banks, as well as any accounts payables or bills that it still needs to pay to any suppliers or vendors that it may work with. The third aspect of creating the balance sheet is going to be the owner's equity section, and this of course is going to be any capital that's been contributed directly from the shareholders or specifically from the owner of the convenience store, plus any retained earnings that have been kept from the profitability of the convenience store, less any dividends that have been paid out to the owners. For further additional questions, contact us at utworkingcaptial@gmail.com.